Hello, it's Guy Costin, and I'm so excited to introduce you to Dakota Live Podcast. If you love Dakota Live and our allocator interviews, you're going to love the Dakota Live Podcast. It's hosted by Robert Moyer, one of our investment sales professionals, and the allocator. And just like on Dakota Live, in those interviews, we ask them all the pertinent questions about themselves, their platform, their searches, go really, really deep so you can get a deep understanding of who they are, what they do, and their platform. If you haven't had a chance to get caught up on Dakota Live Podcast, now's your chance to do so. You can do it right now on Dakota Marketplace, Spotify, or iTunes. You're going to love them. Welcome to Dakota Studios, the premier location for all of your video production needs. Our studio is located in the heart of Center City, making it easily accessible for companies of all sizes. Our professional production team is dedicated to creating high-quality videos that showcase your products and services in the best possible light. We understand the importance of video in today's digital age and are here to help you take your business to the next level. Whether you need a video for your website, social media, or to showcase at an event, we have the expertise and equipment to bring your vision to life. Don't miss out on the opportunity to showcase your brand and products in a dynamic and engaging way. Contact us today to schedule a tour of our studio and discuss your next project. We can't wait to work with you and help you take your business to the next level. What's up, everybody? Welcome to the Emerging Manager Growth Show, Episode 9. I'm joined with Dan DiDomenico, our president. Dan and I have worked together since 2008. So happy to have you on the show, Dan.
Thrilled to be here.
Thanks for joining. Steve. Today's highlight is RIAs. So we're focused on RIAs. We're going to go through emerging manager RIAs, emerging manager programs, conferences, who are more amenable. So questions, Dan, why do we do these calls? Let's just talk about that. So if this is your first time listening, we want to walk you through why we do these calls.
Yeah, I mean, look, we're all in this together, number one. We are out there calling on the RIAs together as a team. It's a really important channel, but even taking a step back to that, it's really trying to reinforce the process that we take in approaching anything that we do in marketing, investment, sales, strategies. So what we like to do on these programs is really come to you with thoughts, some ideas, and really try to dig into a specific channel. So you, as an emerging manager, as a boutique asset manager, we appreciate that because we're doing that every day, either with new assignments and new partners, or we have a track record, certainly, of taking strategies and investment managers that are very early on in their life cycle and bringing them to the market. So we try to share with you some of the experiences that we've had along the way.
Yeah, and we're not in an ivory tower. Yeah. We're in the market every single day. We raised about $25 billion since 2006, but we just launched last fall with Spruce, an emerging manager, and we want to make sure that you guys know this. We're out in the market taking a brand new strategy now. Their firm's 15 years old. It's a private credit strategy, basically construction loans for multifamily. They take the whole loan, generate 14.5% net, but they had a little penetration on the RA channel, no dedicated sales force. So you're going cold to cold, new to new. Yep. And it's really important that you all know that we're out there walking the talk. We're not just sitting there for the ivory tower, giving advice.
And for all intent and purposes, it's a fun one. Right? Yeah, it's the first time really going out fundraising for a commingled LP vehicle like this. So we understand that there are places where you can take a strategy like that, and that's what we want to try and bring to you, some of those insights.
Yeah, and we already had a question from the audience asking about a first close emerging manager. It is the toughest, right? We're going to walk you through how we go about it and how we recommend that you go about it. So what we're going to cover today is we're going to go through, so just briefly, Dakota, we've been a third-party marketer, not so much like on a placement basis, but much more dedicated team to about 6 investment firms where we're basically their whole sales team, all 7 of us, out raising money every single day, based in Philly. 2019, we started a content and database business, which we'll reference from time to time because having good, clean RA data really makes such a big difference. And being
Very
able
powerful.
to slice and dice this information so you can kind of get to what you're looking for more quickly is what this is all about. So, Dan, the theme is absolutely RAs, but a bigger theme, okay, is you have to do more with less. Yeah. As an emerging manager, you have to do more with less. All of the tools and techniques that we're going to recommend basically are free. That's the good news. You don't have to go out and have a big budget, do PR, spend a ton of money, advertising, whatever it is. You can do it on a very tight budget, but it will take some shoe leather. I mean, it does. It's going to be a grind. So we're going to talk about that, and then we're going to talk about the emerging manager conferences. Our team has surfaced some unbelievable conferences. I think we have over 600 conferences in Dakota Marketplace, but we're going to show you 10 upcoming emerging manager conferences at the conclusion. Then I'm going to give a little tutorial on what I'd consider the secret weapon to an emerging manager, which is your quarterly webinar, again, which is time, not a lot of cost, basically free, where you can get exponential leverage. So, Dan, okay, one thing I want to do is define what an emerging manager is, just very quickly. Kind of, I mean, there's massive latitude on this, but it's kind of south of 3 billion, if you will. But I want to be really, really clear. There's a concept of an emerging manager, then there's a startup.
Correct.
Okay, so the startup thing is really, really difficult. An emerging manager kind of means you're at some level of scale, 50, 100 million, that kind of range. If you're down below 25, you're more friends and family passing the hat to get to that critical mass.
It could also be limited track record.
Limited track record, yeah.
So
let's do it. Let's kick it off with the first thing. So what we want to be able to do with you all is demystify common questions of attacking the RA channel for an emerging manager. So Dan, let's come right out. How long does it take to raise money in the RA channel for an emerging manager?
Yeah, the way we always think about it as a team and the way that we discuss that point of the first call, the first meeting, and what should the expectations be to the point where you're moving through due diligence and you get that important allocation from an RIA. We always say it's 9 to 36 months, if not even longer than that. So I think the common misconception is that this is a very transactional end channel. It's not. We always approach it very much in an institutional manner because many of the people, directors of researches, the CIOs, they've come from institutional consultants or they've been at an institution where they've played the role of a CIO or director of research. So they take it from that approach. So we take any type of conversation and supporting a due diligence sales cycle very much in a consultative manner, acknowledging and accepting the fact that it could be 9 to 36 months, if not more. But I will tell you, the reason why you want to approach it in that manner is that these are very long-term sticky assets.
Right.
So that's why it's a great end channel. It's not only the fact that they're going to be independent, they're going to be thinking very much from the standpoint of how can they differentiate their own portfolios, but they end up being very long-term allocators.
So Dan, let's talk about, if you're talking about time, let's talk about expectations. So walk our audience through how important it is to set the proper expectations for the PM ahead of time, right? Because we all know, if you all want to get a big laugh, right, the expectation of a PM is to raise money's up here, and reality is kind of here. You know what I mean? That's the gap, and it's our job to manage that expectation. So just walk, because really, we just closed on our first $8.5 million into the Spruce private credit fund. Okay, we started marketing them last November, and it's it's May.
About 9 months.
Right.
Yep. About 9 months in.
And had we ever had any money? I don't want to mention the RA, but had we ever raised? Had they ever allocated anything to us before, or was this a new?
This is a new.
Yeah. So how about that? So we didn't even leverage an existing relationship. We obviously knew them. They hadn't allocated to our strategy. So my point is just persistence, okay, with covering your sales plan and covering the top RAs. Generally, that's the way to do it. We can't make any promises, but it's worked really, really well for us, and you just have to have that dedicated approach. We'll talk more about that. But
you made a great point, setting the right expectations with portfolio managers. So within your conversations, because we're all trying to not only get that meeting, we certainly want to bring the portfolio manager into that conversation. Up front, you just want to make sure that you're being so clear with them that first meeting, that first interaction where you bring them into that meeting, it's not going to immediately translate into an allocation. And that's okay, right? That's what you want. You want to make sure that they're aware that this is a long-term sales cycle. You're going to be consistent in your follow-up and making sure that you're providing value along the way. Guy's going to talk some about the content that you can create to help support the conversation, to help fill that quiet time in between meetings. But you have to make sure that the portfolio manager is fully aware this is a long due diligence cycle. And the more at-bats that you get, the more that you're going to have in the pipeline. And clearly there's a lot of great allocators within the RIA space for you to have that number of RIAs in the funnel, in your pipeline. And ultimately, your consistency will lead to great results. And as I mentioned, this is a great long-term sticky allocators within the RIAs.
So let's talk about Dakota Marketplace just in terms of making it easier for you to set up meetings. So we recommend always having 5 cities on the calendar at any given time. Circle 9, 11, 1, 3, and 4:30. Have your very tight email, typed subject line. We'll send out a document after this. And you're just city scheduling against those RAs. If you want to pinch, if you're an emerging manager, the RAs should be, the top 250 should be your target year one, right? In the kind of the 6 to 8 top metro areas. And the goal is to make sure you're constantly reaching out to ask for a meeting. They need to have a very tight one sentence description of your strategy in your firm with a clear call to action. Can you meet May 26th at 3 o'clock? It has to be that, in our opinion. Any wishy-washiness or, hey, can I meet you that week one time? Clear call to action, really tight email. So in the subject line should say meeting request. So we'll send out our whole Rainmaker document that goes through all of this in detail. But when you think RA channel, okay, as we were just talking, 9 to 36 months, number one, clear sales plan you're sharing with your PM. And then you're saying to them, hey, we've done these meetings, we've covered this ground, and this has been the feedback that we're getting, and you keep them in communication, then the expectations start to get in line. So Dan, do I need a certain asset size or track record before calling?
Absolutely not. You want to get started right away. There are going to be those within the RIA space that are what we refer to as early adopters. They're the ones that are going to be able to provide that critical, if we're talking about an investment strategy with a low asset base, they're going to be the ones that are going to provide that critical 5 million, 10 million, 15 million, 20 million into the strategy to help you get to scale. Now look, are there going to be some within the RIA space that are going to push back and say, I can't be a certain percentage of the strategy? Absolutely. But that's just where you're going to be able to categorize and separate them out to know once you hit those key milestones of assets under management or within that strategy, you're going to be communicating to them along the way. So you don't want to stop following up with them. So they're fully aware of your progress against what you believe or what they've communicated to you as those asset levels. But this is I believe, the primary channel, the RIAs, for you to get to those points of critical mass in 100 million, 200 million, and beyond in the strategy.
And it's consistency of application, it's consistency of asking for meetings with a really tight email so someone can evaluate you, and then it's doing it day in and day out very consistently. A lot of people like to come in, parachute in, do a couple meetings, and never show up again. You have to be willing to apply it consistently day after day after day. So,
and the beauty of it is that this is not a channel that has standardized, you have to have a 3-year track record at 100 million. Everyone's going to have a little bit of a different view on that, and many of which are going to give you credit for potentially prior experience at prior firms, right? Because they're all looking to find that underdiscovered, that differentiated manager, so they themselves can differentiate their own book of business, their own practice relative to the competition that they're seeing out there.
And you
in
never
the RIA
know.
world.
You never know. So you got to make the calls. You have to make the calls. So, following up, one of the most important things are the questions that you ask to end a meeting. A lot of people say to me, Guy, what's the follow-up after a meeting? I said, there is no follow-up after a meeting. The follow-up's in the meeting, at the end of the meeting. The follow-up is in the meeting. 2 questions. If you're long only, do you ever see, would this strategy fit in your portfolio, this type of strategy? If the answer is yes, you can ask the next question. If it's no, you got your answer, you can move on. If the answer is yes, then you can say, are you going to do a search in the next 12 months in large cap growth? If they say yes, now you know what can we be included? Yes, okay. What are the next steps? If they say no, then you know where you stand when you leave the meeting. Most salespeople leave the meeting not asking the 2 hardest questions. So if there's anything that I can leave you with for an emerging manager, you have to be not afraid to ask the tough questions. So,
Yeah, you got to remove the noise in your pipeline.
right.
Right? That there's certainly going to be something you're going to move into more of a longer term evaluation bucket. That's okay. Because you want to focus your time on those that are potentially real allocators that have real assets that they can actually invest in your strategy. That's where you want to focus your time.
And Dan, myth number 3, that's well said. Do I have to be flexible on fees?
Look, I mean, the mutual fund world, we all know you're very fixed in your expense ratio and your fees, so that's a little less of a concern or an issue. In those early days where you can be flexible to compete for mandates, I would say the answer is absolutely yes.
Yeah.
Where you can do it, that's going to be a huge benefit. Because what you can then provide is this sense of, look, early you're going to get access to our strategy at preferred terms. And RIAs love to be able to say to their end clients that we're accessing what we think is a great diamond in the rough, one that has been underdiscovered, early days of their own life cycle, but a really high pedigree, great process, great team. And this emerging manager is not going to be an emerging manager for long, but we're going to get access to them early at these preferred terms. That can go a long way.
Yep. So now, as we get to myth 4, because now we're going to dig into some details, some specifics in the RIA channel, custodians, et cetera. But Dan, let's talk about, a lot of people say they only want to call the larger RIAs or only RIAs above $1 billion.
Love that.
Yeah, please. And I love it too.
We don't disparage, and you can't. And here's the reason why. Number one, a $500 million RIA or even a $300 million RIA, when they have a nice concentrated grouping of investment managers with whom they're partnering, those are the types of $5 million, $10 million, $20 million allocations that you're looking for. But more than that, what we're seeing as a massive trend in the RIA space right now is consolidation and the movement within the RIAs as they all look for efficiencies in their own business models. But one of the great ways to become more efficient is to have more scale. So you're seeing these RIAs merge or be acquired. And the beauty is once you have that established relationship with a $300 million RIA that just got absorbed by a $5 billion RIA, is that they bring you with them. And now you have exposure to that research team. You have exposure now to a much broader set of assets and clients. So we love calling on the quote unquote smaller RIAs for that reason.
We love them. Cover the big ones, of course, because they love new ideas, but the little ones do as well. So Dan, question from the audience. How important is third-party due diligence in the RIA channel?
It is certainly an aspect to, as a center of influence over the RIAs. So those third-party researchers, we're talking about consultants, right? So the once upon a time very clean lines between institutional consultants and RIAs become much more blurred. So you do have the likes of a Fiducian. You have the likes of even a Cambridge or a Callan with their IAG group, where they have influence over RIAs that are relationships of theirs, where those RIAs want to outsource research to a certain extent. So cover them, absolutely cover them.
Yeah.
So institutional consultants, especially those that have an OCIO or an outsourced practice where they're reaching out and they're establishing relationships in the wealth intermediary world of RIAs, you want to cover them, but you still have to go direct to the RIAs.
Yep, and also we cover all of the OCIOs. If you're a subscriber to Dakota Marketplace, they're all in there, and it shows a lot of the clients as well. Okay, Dan, let's just give us a sense of how we distill the RIA channel from 32,000 RIAs down to 2,500. Define the channel for us a little bit.
Yeah, and this is critical, as we talked about emerging managers, having to be efficient with your time, is you have to be able to separate out the wild number of registered with the SEC RIAs relative to those that actually use outside managers, right? You can spin your wheels and spend so much time trying to separate those that are asset managers that do what we do, or those that will look at your strategy and work with and allocate to outside strategies. That's where Marketplace comes into play, is we've spent our careers doing that, and now we've made it accessible to those that are our members through Marketplace, in separating out those that matter the most, those that actually allocate.
100%. And let's talk, just give a sense of the custodians that we recommend focusing on.
Yeah, so that's going to be the Schwab, that's going to be the Fidelity, so the NFS platform. That's TD, it's Pershing. Those are the big ones that the RIA space would access mutual funds or separately managed accounts through their marketplace platforms that they've created.
And depending on the style of your strategy and the asset class it covers, the TAMPs.
Oh yeah, so the TAMPs, and there seem to be new ones that are emerging even as we speak. So the likes of a SmartX as an example that spun out of Envestnet. Envestnet obviously being the behemoth in the space. So one of the things is to break down with Envestnet is they're not a custodian. So where you may have to be accessible through Envestnet, you're still going to have an underlying custodial relationship with a Schwab or a Fidelity as an example. But other ones that you would want to focus on, again, depending on your asset class, a Case and iCapital, if we're talking about alternatives, those are important programs and platforms to be mindful of. Again, as I mentioned, SmartX seems to be another one that's really growing quite rapidly in the RIA space.
For SMAs, because that comes into the question around what are the structures that RIAs like the most?
Perfect segue. And it's really that capability to deliver technology is the backbone for these RIAs. SMA platforms and UMA is becoming more and more prevalent. So where your strategy can port well through mutual fund, SMA, and UMA, so model delivery, that's where your chances of competing on those platforms is elevated. You're going to carry a higher priority where, again, the technology that they're attempting to bring to those RIAs, where they can access you across all of those vehicle types, all those structures, the better.
Great. And please fire the questions away right on the right side of the screen. So please ask questions. We've already had a bunch of good ones. Dan, let's talk RIA aggregators.
Yeah.
So when we look at the aggregators, just want to go through what that means. But we're seeing such growth of these RIA aggregators.
Yeah, it's incredible. And the more recent developments around the likes of a First Republic or a Silicon Valley Bank, where you see these great wealth management advisors and programs, those teams, you start to see that movement, right? And that what emerges out of it are even more aggregators. I'm thinking of a Crescent as an example. They've been aggregating RIAs, and now they're well over $50 billion in assets. And I don't see that changing anytime soon. It's clearly their method and their plan for growth. Dynasty is another one that has been gobbling up RIAs, bringing them under their umbrella. They speak a little more specifically to like the wirehouse spinouts that are still looking for support in their business, but they want to do it in more of an independent way. Dynasty is a great destination for those RIAs. Hightower, that's another one. They've been around for quite some time. I even think about like a Rockefeller. Rockefeller that put a very clear plan into place when Fleming joined to say, we're going to build this business out over the next 5 years to be over $100 billion. They've exceeded that. And it's been all through the recruitment of the wirehouse teams that were looking to break away, but they need a home, they need a destination. So we look at Rockefeller really as a consortium of individual RIAs. We call on those teams individually.
Yeah. And so all of this information is in Dakota Marketplace. So Dan, let's talk, and we're going to tell you what we believe some of the early adopters, but it's important. Please don't give Dakota any attribution. Just reach out to them, reach out to due diligence analyst, set up the meeting, no attribution to Dakota. But why don't you tell us who you've seen historically who are willing to be early adopters in emerging manager firms and strategies?
And for those of you that tune into our Dakota Live calls, our last episode, we had a great interview with Adam Landau, who's one of the managing directors, partners at Permit. Permit just got acquired by Cerity. Right. And he talked a lot about still the desire and the interest in emerging managers, boutique managers. So this is another good point of advice for all of us, is even when a Permit gets acquired, there's still a target. You still want to call on them individually because there's needs specific to a Permit relative to maybe the other RIAs that now roll up under a Cerity. Yeah. Right. So Adam gave great advice and still calling on them individually.
And we will include in the follow-up the link to the interview with Adam. It's an amazing interview. It really gives you clarity into how you should be thinking about attacking the RIAs and some of these aggregators. Even they do get big, still going to Adam, who is Permit.
Right? Yeah, Crescent's another great example
Crescent's
of that.
A great example, yeah.
Ballantine in Boston, I know they have, and we've worked with it in the past, they have a specific platform within their business dedicated to emerging managers. They have clients that ask for it. So many of them, Ballantyne as an example, would certainly be a prime candidate because they want to make sure they have a right set of managers and strategies that they can present to their underlying clients that have demand. BDO down in Baltimore, yes, they've grown as well. That was the old Beagle and Waller, but they've always been willing listeners to look at and to allocate to early stage managers and strategies.
No doubt. And just to recap, Dan, as we're thinking about approaching RAs, it's an unbelievable channel for emerging managers. RAs are always looking for new and interesting investment ideas. And if your emails are clean and tight, okay, and they make sense, they communicate, hey, I'm requesting a meeting at this date and time. This is who we are and what we do, very succinctly, make it very compelling, a clear call to action. Can you meet May 26th at 3 o'clock? The email is everything, right? It has to be written that way. And starting off, you need to set expectations properly in a sales plan with your boss. This will take 9 to 36 months. Number one, and I do want to answer one more question. Any ideas? But hold on one sec. I just don't want to forget. Any ideas for getting on case or iCapital? Any shortcuts, if you will? So any insight there would be great. But so you think about it, set expectations properly, employ city scheduling, 5 cities at all times on the books, scheduling 9, 11, 1, 3:30, and consistently doing that. And then when you do the meeting, make sure that you close the meeting and ask the 2 toughest questions. That will change your life, right? It'll clean up your pipeline. It'll give you clarity on what they really think about your strategy. But it's the consistent application for an emerging manager. And lastly, webinar.
Yeah, so I was going to ask you that question.
Okay, let's go.
Share the advice with our audience here about just how powerful webinars can be.
So we will supply you with our ebook on webinars that goes through a step-by-step process. But number one, it's important that you do it because all of your potential clients want to see what it's like to be working with you when they go through the prospecting process, right? Through the due diligence process. And by communicating clearly what happened during the quarter, key insights, and your outlook, and the entire time you're showing your investment strategy and highlighting your investment strategy, you can completely control everything. You're sending 4 to 5 emails, save the date, right? You're just inviting somebody to a really high quality, informational-oriented webinar. A lot of times, when they become clients, they're taking that information and they're giving it to their clients. So it's really, really critical. And you're able to script out exactly what you want to say. So you can tell your audience exactly what they want to hear. And then when you're finished, you end up having a replay, video replay. You transcribe the call. You do an abstract of the call. And all that information goes on your website. So you create an amazing amount of content. So the benefits are truly remarkable of building your brand. And it allows you to really flex your muscles and show you how strong and intelligent and thoughtful the PM team really is. So we strongly recommend getting leverage with quarterly webinars. And with that, just closing comments, Dan, on
I think you wanted ideas for case and iCapital.
That came in from the audience, yes.
Yeah, look, and I would treat this comment and your approach with any platform, right, is where can you be creative with them, right? Where can you potentially provide a period of exclusivity? Where can you provide potentially preferred terms with them, right? So try and think about it from their seat. We all know what we're trying to get out of it, but how can you potentially make either their lives easier or make them look better in their role by presenting to them an idea that's just a little outside the box versus just asking to be on the platform?
Great. And Dan, any closing? We're going to share the Emerging Manager conferences that you can see behind us. They're going to be up in 1 sec. Unbelievable run, I think, of about 10 conferences that are up and coming. We'll send this out as well in the follow-up. And so like we've been saying, there's great opportunity with the RAs. We live and breathe that every single day. We just won $8.5 million, took 9 months, but now we have a really nice pipeline. So we're living it. We're here to support you in any way that we can, answer any questions, demystify anything that you may be thinking. And with that, thanks to our tech team and everybody. And Dan, thanks for joining us.
Thanks, Keith. This is great.
You got
I really enjoyed it.
All right, everyone have a great day. Thanks for joining.
Thank you.